Hello, my name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 30 minutes on Options Guide TV. Today's date is Monday, May 6th. The markets are open, they're rocking and rolling, and we kind of had a little bit of a breakout in the S&P 500 index. Markets once again are still trying to discern what's next for the Fed. The fact that the potential rate decreases have been pushed all the way out to basically September. That's what the futures are saying, is that September is the most likely time that we might have a rate cut. Strong earnings, and you could also say wishy-washy earnings, but it's interesting in that NVIDIA has been a big driver and mentioned a lot in all of the earnings forecasts, but they have not announced earnings yet. So we'll be looking at NVIDIA when they come out at the end of the month. They're the last ones of the Meg 7 to actually announce, or the last company of the Meg 7 to announce earnings for this quarter. We also had the big event, Warren Buffett. We talked a little bit about my little anecdote about Berkshire Hathaway from way back when I was a very young broker at Charles Schwab and Company. And that was a little anecdote that I shared with everybody on Friday's show. But Buffett came out and said that they will be selling a little bit of Apple, and it has nothing to do with the company. It's just that it's becoming a huge part of their portfolio. And so Apple is down a little bit today, probably on that news. And they've already sold a little bit, but they're going to continue to sell a little more just to try to rebalance the portfolio. And Warren also announced a successor and reassured everybody that this is a forever company, that they put everything in place to make sure that Berkshire Hathaway will succeed going forward. But he did. Once again, just amazing. He answered questions for about 5 hours on stage, took every question and didn't dodge any of them. And just a great event that happened over the weekend. So by looking a little bit, and let's pull out and let's start in the S&P 500 index. If we look at this chart and you look at we got the 200-day, let me zoom in a little bit here. Let's go right in this corner. All right. And we obviously, if you look at this chart, we broke above the 20-day and we had the 50-day moving average breaking above that too. So we're right up, bumping up on the 50-day moving average. Here's the 200-day, here's the 20-day. Right along this trend line, all the way through here, was a defined trend line. Also, even if you come up from the bottom, you're having basically the wedge pattern that's coming in, and we've broken out there. So I think the fact that today we're up again, up about 27 points right now, trading at 51.55. I do think this trend's going to stay this week. It's obviously a defined moment. It was hanging around the 20-day moving average. We finally got a breakout on that. And now market's looking a little strong. Now, this is considered a death cross in that the 20-day crossed over the 50-day moving average. But that by itself, once again, it's worth mentioning. But I do like the fact that there was a very strong trend of higher highs or lower lows that got broken up here in the short term. And now it's basically free burden right now, if you will, right? And so because of that, I don't want to stick with a skip strike butterfly. I don't want to do an iron condor. I am going to stay with the strategy that we had the last, I think 2 out of the last 3 weeks, where we just are going to get long our long call spread. Now, last week we had adjusted it, and then our adjustment worked out great. So the market was bullish last week overall, and the market went down. We adjusted into a butterfly, came up to Friday, and we actually hit the center point of our butterfly, but then it continued on up. So you would have had to get out Friday morning on that trade. Hopefully this week we won't have to adjustment. We're just going to put in a long call spread and we're going to sell the most at the money option contract and buy a deeper in the money contract. And this week, we're going to look at a 10-point wide spread. Mentioned a few times on Options Guide TV. I try to want to kind of keep the risk when we're looking at just pure bullish plays, like to try to, or bullish or bearish plays, like to keep the risk right around $300 or $400 on our 1-by-1 spread. We're going to go a little bit more than that. We're going to go a little bit wider, and it's basically because when you make the adjustment makes a little bit more sense. But also, when you adjust the trade, if you have to, if the market goes down 1% or so, you'd be looking to make an adjustment and rolling into the butterfly. When that does happen, you do actually add additional risk because you have it always goes hand in hand. You have more upside if you're doing a wider spread, but then if you make the adjustment instead of a 5-point margin, or instead of having the 5-point wide spread, you then have a 10-point wide spread in the butterfly, but also means that it can land within that range. You got a little bit wider range in order to do that. So let's set up that trade. So let's go in. We're going to look at Disney today too, but we started with the SPX chart. So let's jump over to the SPX. We're going to do the Friday expiration. So this Friday is going to be May 10th. So here's the May 10th expiration. Click on that. Want to hit that. Okay. And I always want to confirm that it says May 10th over here. We have the calls on this side. We have the puts on this side. The market is at 151.5742, up about 0.5% today, which is about 30 points. So obviously you double that, that would be about a 60 point, would be about 1%. And that's kind of where our range would be on the downside. If the market started going down and we're down around 1%, is when we'd look to possibly adjust this trade. So markets right here, the most at the money option contract. I'm kind of sad, and that is a W. Okay. I'm kind of sad that we don't have 2.5-point strikes here. So we're right in the middle of it, which makes it a little bit tougher to do. 160. So you got to decide when you're in the middle. Do you want to go down to the 150, 51.55, or do you want to go up to the 51.60? And I think I'll do the 51.55. Let's do 51.60. I just changed my mind. I apologize. Here we go. 51.60 is going to be the one that we're going to sell. We're going to go to the 51.50, and that's going to be the one that we buy. And we're paying $5.70 for the potential to make $10. So $4.30 worth of upside. Total risk is $570. And if you think about it, we're right at the money. We need the market to go up about 2.5 points in order for this to max out. But we're still willing to get this trade done for $5.70. The risk reward is fairly decent, right? If the market just stays where it's at, we're fine. If the market continues on up, drifts a little bit higher, we're golden. If it drifts a lot higher, then we're golden without a lot of nervousness. So there's two solid scenarios. The market stays where it's at, or the market drifts higher. The market drifts lower, it's got to go below 51.50 before we start getting a little nervous. And it would probably trade, like I said, around the 51.20, 51.25 mark before we would think about adjusting our trade. And normally, if we're going to do that adjustment, we'll make that adjustment before Wednesday if we're doing a 1 week long trade. So here is, and I'll just send this to the what if calculator. And there we are. Scroll this down. So this kind of shows you this is where the market is at. Let me zoom in, get a little bit more of a slant on this. And this is where the market is currently trading at right here. This is where our break even is at. There is a lot of time premium just because the S&P 500 index is a very high priced index. That adds a lot of juice to these option contracts. So right in this range to start with, we have a fairly flat line. You know, one rise over run would be like 1-to-1. And then as expiration approaches, this will start morphing into Let's go all the way to Thursday. Now we get a little bit more defined. And then Friday, this would be 11 o'clock on Friday, a little bit more defined. And then we'll go and make it 16:09. And now it's looking a lot like it is here at expiration. So that is the process. It's going to take a while for it to max out. You either need it to go way deep into money, or you need some time decay. The maximum amount of time decay in the S&P 500 index, you get a ton from Thursday to Friday, from Wednesday to Thursday. Then obviously from Thursday to Friday, there's a huge amount of time decay. And I would even go so far as to say in the afternoon, after the Options Guy TV show, is really when you start to see that time decay happen in the S&P 500 index. So Wednesday's a great day to adjust if you need to adjust that trade. And this is going to be our paper trade for the week. So I'll go back and put it in, and I'll give you a read back here. We're looking to buy the May 10th expiration 5160 call, or we're going to sell, I'm sorry, the 5160 call, and then we're going to buy the 5150 call. Once again, that May 10th expiration. Right now, the midpoint is, we'll say 570. We'll keep it right there. Usually midpoint fills are very feasible in this expiration and this underlying, especially on the at-the-money option contracts right around where the index is currently at. And that will be our paper trade this week for the S&P 500 index. If the market goes against us, what we'll end up doing and how we look to adjust the trade is we'll sell another one of the 5160s and buy a 5170. Now, that just gives us a chip in a chair. We're not adding any risk onto the trade. We got a little bit wider trade that we're to do this, and it's a little bit quicker of an adjustment because we are going 10 points wide, so we don't quite bring in as big of a credit. So let me remove this leg, and we'll see where this spread is trading at right now. So 570 is what we paid for it. I'm going to write that down just to make sure I have that note, and we will get rid of this leg. Oops, wrong thing I did there. 51, 10, 60, doom. Let's just start over. Okay. And so on this one, we're going to be looking to sell the 5160. This is the adjustment. Remember, we have a position on. We're long a spread. In order to make it a butterfly, we need to get short a spread. So we're going to sell the same option contract that we sold to start with, 5160, and buy the 5170. So right now that is trading for $5.10, implying that the butterfly, if we paid 570 and 510, the butterfly in general would be 570 minus 510, or it would be trading for about 60 cents right now. So if you were to just do a 10-point wide butterfly, it would be trading for about 60 cents. All right. Now, if I paid 510 for this and I want to manage my risk, how I would determine when I want to make the adjustment would be if I saw this trading for around $2.50 to $3. Somewhere there, you got to decide where you want it to be. That means the market would have gone down, and this spread would be worth less than it is right now. So what I'm trying to do is I don't want to risk the entire $5.70. So you can say, well, Brian, why don't you just sell it when it goes down? You can. That's possible that you could just sell the long spread and get out. You're selling to close the long leg and you're buying to close the short leg. But in this instance, and this happened last week in our 5-point wide spread, in this instance, you take some of the risk off the table and you still have a chance that the market may come back and land within your strikes. So, and this is the reference I made, you have a chip and a chair. As long as you're in a poker game and you still have chips in front of you, you still got a chance, right, to come back to win money. But as soon as that last chip goes away and you close out that position and walk away, then you don't have any chance of winning in that poker game or poker match or however you want to call it, card game. So by doing this, We're not completely out of the trade. We still have a chance that it can come back. We're going to take a lot of the risk off the table. So my total goal here is I'm going to start by risking $5.70. If I can bring in, let's say $3, just to make the math simple, then we're looking at $2.70 worth of risk. That will be our total risk. We haven't added any risk to the trade. All we've done is built a butterfly kind of weirdly. We legged into it, and that's just the simple adjustment. And another little anecdote that I always like to use through all the years is I'm doing the trade where I don't want the cheese anymore. Just let me out of the trap. And that's the way that I approach this strategy. If I want to get bullish on the S&P 500 index, now we've always made different adjustments, but on Mondays we try to make a little call on the marketplace. And this is the trade that we do. We got one adjustment. If that doesn't work out after that adjustment and the market continues to go on down, oh well, we cut our risk in half by adjusting that trade. And that's just the way that you approach it. So you have three different scenarios that can happen for you, right? You put the trade on, and if the market goes up, well, that's awesome. Market stays where it's at, you're still okay. Market goes down a little bit, well, we're not going to get out because we want to still have the chance that it could come back. So if we get volatility in the marketplace, we're still okay. The market goes down, we adjust, we remove some risk, but we still got a chance that it could come back. So you're giving yourself a lot of scenarios where you're going to be okay. You can still lose on the trade without a doubt. The market could just go down and stay down for the week. But if you get a little bit of a whiplash and it comes back, which is exactly what happened last week, you still got a chance to be able to get out of the trade at even. Now, here's the big thing, and I should have emphasized this, that if you do put this trade on and you pay $5.70 and the market goes down, I'm not expecting to make money at that point. Now I'm just in a mode where I want to try to get out at break even. So it goes down, you have a 10-point wide butterfly. If it comes back and it starts trading within the wings of the butterfly, then if it's trading for $2 or $3, I'm going to probably just get out of the trade. I'm not going to hang around and try to make it profitable. If I can get out at break even, then I'm happy. I live and I go and do and see another day, right? No problem at all by doing that trade. So that's the emphasis on the trade. So let's go in, add another one of these. We're going to hit the bid on this. We're going to do the 550, and that would be the trade that we'd be in. And I mentioned it would be 60 cents. Let's send this to the what if calculator. Let's zoom in on the trade. All right. So two of these, adjust this. So we start with the 51.50, selling a 51.60. Now, I was going to try to do the adjustment, but I can't get the quantity to adjust for me. Yeah, we can add an option. I could do it that way. So in this instance, we'll go 51.60. Just not moving fast enough. Yeah, I'm gonna let it go. It's not moving fast enough for my liking. And we still got a lot to do on the Disney trade. I was going to show the adjustment. If you start with the long call spread, you do the short spread, and it rolls into the butterfly. But so we're going to start with the 51.50, selling a 51.60. The adjustment would be we'd sell another 51.60 and buy the 51.70. That's trading for 70 cents right now. We would have it on for about $2.50 or $2. somewhere in that range. And we would have an expensive butterfly that's on, but it's going to be the way that we're going to adjust the trade. All right, so Disney in the news all over the place. The chart of Disney is scary a little bit, but it got a little bit of a forming of a head and shoulders here. Little bit nervous about it, but we did have this little breakout here. So let me highlight that. Right. Once again, we're right around the 50 and the 200-day moving average. And we got a little bit of a boost up today based off of earnings probably going to be announced tomorrow. So it's an interesting one to trade. And we'll do what I think I would like to do on this trade is a skip strike butterfly, or a standard butterfly was looking real interesting. So maybe this week we'll just do the standard butterfly. So let's go wide on this. We're going to buy the 120. We're going to be bullish. We think that there could be some good. Disney's tired of getting beat up, and we're going to buy this. Okay, so we're going 5. Oh, skip that one. Not the 129. I want to do the 130. There we go. 60 cents. So a minimal play. The skip strike doesn't really work here. Even though it's trading at 73% implied. I looked at a couple of skip strikes, and there wasn't a lot of scenarios where I felt comfortable with the trade and I could get it done for a decent net credit. So that makes me lean towards the butterfly, and that's what the thinking is here. So our trade for Disney, who's going to announce earnings, is to do the short-term option contracts, the May 4th expiration. We're going to buy the 120, sell 2 of the 125s, buy the 130. Here's the May 10th expiration, right? 4 days away. And we're in that right expiration. We have 60 cents is the midpoint right now. We're going to assume that we could fill it fairly close to that. We'll keep it right at 60. That's where we had it at when we started. And very simple, very straightforward trade. We need it to be bullish. There is no real hedge on the downside. We might be able to adjust the trade if we wanted to. We could roll it into a short spread, but that would be all about the premium after the trade is done. This is basically a lottery ticket. You want to see about the expected move, by the way, is around 6%. You're looking at about $7, which is $3.75 on the ask. 116 is where the market is at. Yep. And $3.55 is the midpoint here on the 116. Over here, the midpoint is $3.50. So that's about $7. $7 going into 116 is about a 6% move. So that's the expected move, and we can get there. We're saying that we can get there with that type of move. That's somewhere that would land in this if the direction is right. And then we go all the way up. This is where a 1 standard deviation move would be, is right at the 125 strike, where you'd like the stock to end up at. And it's saying right now there's about a 17% chance of it finishing 1 cent in the money by that Friday expiration. So that's the layout. We just need to be right about the direction. And right now it looks like the market is leaning that way, up to $2 today at 1.8% on the market. All right. So if you have any questions, you can put them in the chat box, and I'd like to welcome Twitter. We are now streaming live on the x.com, and you can also watch us on YouTube. If you have any comments and questions, you can put it in YouTube and inside the Tradier Hub. So that's it for this edition of Options Guide TV. I don't see any questions at this point in time. And we'll come back on Wednesday, see how the Disney trade did, and see if we need to make any adjustments to our S&P 500 index trade. Thanks for coming. Click subscribe, ring the bell if you're on YouTube, and follow me on Twitter. Handle is @BrianOverby.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.